Money feels solid, tangible, reliable. It sits quietly in your wallet, rests as numbers on a screen, and moves through the world with the appearance of stability. We treat it as wealth itself, something earned, saved, and owned. But beneath that familiar surface lies an uncomfortable truth most people never stop to examine. Every unit of modern money is born from obligation. Not metaphorical obligation, not philosophical debt, literal debt. For every dollar that exists, someone, somewhere, is required to repay it. This is not a flaw in the system. It is the system. When you hold money, you are not holding value in isolation. You are holding a claim that only exists because another party is bound to fulfill a promise, a mortgage to be paid, a bond to be honored, a loan to be serviced. The global economy functions not on stored wealth, but on a vast web of obligations stretching across households, corporations, and governments. And yet, this reality is almost never discussed. We debate inflation, interest rates, recessions, and growth. But we rarely ask the most fundamental question of all. Why does money have to be created this way? Why must money always be tied to someone else's burden? Why does the system require expanding debt simply to remain stable? Most people assume this is natural, that money has always worked this way and always must. But history tells a very different story. There were times when money did not mean debt. There were systems designed around trust, resources, and direct issuance rather than compounding obligation. Some succeeded for centuries, others collapsed quickly, but all of them proved the same thing. Debt-based money is not a law of nature. It is a design choice. And like all designs, it can be examined, questioned, and changed. Before we can imagine what money could be, we first have to understand what it actually is today and how deeply debt is embedded at its core. Most of us carry a simple story in our heads about money. We are taught to believe that banks are neutral intermediaries, safe vaults where we deposit our earnings, which are then lent out to those who need them. We picture a tidy system of savers and borrowers, working together in harmony. It is an elegant, intuitive idea. Money is a finite resource, and banks simply move it from one hand to another. On the surface, it makes sense. You deposit $1,000. The bank lends it to a homeowner who buys a house. The economy hums. Everyone wins. The story reassures us because it feels fair, understandable, and orderly. It implies that wealth is real and tangible, that it exists independently of promises or obligations. But that story is incomplete. In reality, it is largely an illusion. Banks do not simply shuffle pre-existing money. When a bank issues a loan, it does not take your deposit and hand it to the borrower. Instead, the bank creates new money digitally out of nothing. Your mortgage, your car loan, your business credit line, these loans generate the currency that circulates in the economy. Money is born as debt. Even governments operate under this illusion. When a government spends more than it collects in taxes, we are told it must borrow. Bonds are sold, promises are made, and new money enters the system. Yet once again, this money is always tied to obligation. It does not exist independently. Every government expenditure beyond its revenue creates a future liability, a debt that citizens, knowingly or not, will eventually repay. We believe money is a neutral tool, a store of value, a measure of wealth. But the system quietly insists that money is always someone else's responsibility. And without that chain of obligations, it cannot exist. What we think of as financial security is, in reality, a network of commitments stretching invisibly across the globe, sustaining itself only so long as debt continues to grow. To truly understand the paradox of money, we must look behind the curtain at the machinery of modern finance. Money is not a fixed resource, nor is it a reflection of accumulated wealth. Most of it is created on demand by institutions designed to profit from obligation. Take banks. The conventional story is that they lend out deposits. But in reality, deposits are largely irrelevant to the creation of new money. When a bank approves a loan, it does not transfer existing cash from one account to another. It simply adds numbers to the borrower's account. This is new money, created ex nihilo from nothing. A home mortgage, a business loan, a student loan. Each one injects fresh currency into the economy, but this creation comes with a condition: repayment with interest. Money exists because debt exists. Without it, the system shrinks. Governments function similarly, though on a larger scale. When a state spends beyond its tax revenue, it issues bonds legally binding promises to repay with interest. Banks, corporations, and investors purchase these bonds, and the money enters circulation. Yet, it is again money born of obligation. Citizens are indirectly responsible for repayment. Even programs designed to help people, such as social services or infrastructure projects, rely on future debt to fund them today. This dependency on growing debt is not incidental, it is structural. The financial system, like a shark that must keep moving, requires continuous expansion. If borrowing slows, money supply contracts. If governments stop issuing bonds, liquidity dries up. To prevent collapse, central banks manipulate interest rates, encourage borrowing, and tolerate inflation. Every policy is aimed at sustaining the treadmill of debt. Growth is not optional, it is the lifeblood of the system. In this way, money is less a store of value and more a living instrument of obligation. Your paycheck, your savings, your investments, all are threads in a web of promises. Understanding this is the first step to questioning whether money must always be debt or whether alternative designs are possible. If money is created through debt, the obvious question follows: why design it this way? The answer is not conspiracy, it is incentives. A debt-based monetary system benefits those positioned closest to its source of creation. Commercial banks earn interest on every loan they issue. The more money they create, the more income they generate. Governments benefit as well. Instead of raising taxes immediately, a politically unpopular move, they can borrow and spend today, pushing repayment into the future. Debt allows expansion without immediate sacrifice. This structure also gives central banks immense influence. By adjusting interest rates, they can stimulate borrowing or restrain it. Lower rates encourage loans, increasing the money supply and economic activity. Higher rates slow borrowing, cooling inflation. In a debt-based system, interest rates are not just a tool, they are a steering wheel for the entire economy. For financial elites and large asset holders, the system offers additional advantages. When money expands through lending, it does not enter society evenly. It flows first through financial institutions and asset markets into real estate, stocks, and corporate financing. Those who already own assets often see their wealth rise as new money pushes prices upward. Meanwhile, wage earners experience the effects later, often through rising costs rather than rising incomes. None of this requires malicious intent. It is the predictable outcome of structural design. When money is created through loans, those who issue loans hold power. When governments rely on bonds, creditors hold leverage. Over time, influence concentrates where money originates. Debt-based money persists not because it is the only possible system, but because it aligns with powerful incentives. It funds governments, enriches lenders, and provides policymakers with flexible tools. The system survives because it serves those who manage it. When money is built on debt, consequences follow not by accident, but by design. First, instability becomes inevitable because money enters the economy through borrowing. Expansion depends on people's willingness and ability to take on new obligations. When confidence is high, lending accelerates. Asset prices rise, growth appears strong. But when fear spreads during a financial crisis or economic slowdown, borrowing contracts, money creation slows or reverses. What once looked like prosperity can quickly unravel. Recessions, therefore, are not mysterious disruptions. They are the natural outcome of a system that relies on continuous debt expansion. Second, inequality widens over time. Those who lend collect interest, those who borrow pay it. Over decades, this flow of interest concentrates wealth in financial institutions and among asset owners. Meanwhile, households and small businesses remain tied to mortgages, credit lines, and student loans that require constant servicing. Even governments, burdened by interest payments, must allocate tax revenue toward debt obligations before funding public needs. The result is a quiet but persistent upward transfer of wealth. Third, inflation becomes embedded in the structure. As new debt creates new money, the supply expands. If production does not keep pace, purchasing power declines. Inflation erodes savings and wages, particularly for those who do not own appreciating assets. It acts as a hidden tax, subtle, gradual, but relentless. Finally, freedom becomes constrained. Even individuals who avoid personal debt remain connected to the larger system. Their currency, their taxes, and their economic opportunities depend on the stability of an expanding web of obligations. The system requires participation. Stepping outside, it is nearly impossible. These consequences are not signs of failure. They are features of a design that prioritizes growth through borrowing. And as long as debt remains the foundation of money, these patterns will repeat. If debt-based money feels inevitable, history reminds us that it is not. More than 4,000 years ago, in ancient Mesopotamia, economies revolved around agricultural credit. Farmers borrowed grain from temples and palaces, promising repayment after harvest. Over time, debts accumulated faster than crops could grow. Rulers began to notice a dangerous pattern. If obligations were enforced without limit, land would concentrate in the hands of creditors, and free citizens would fall into permanent servitude. The solution was radical but pragmatic. Kings declared periodic debt cancellations, jubilees that wiped the slate clean. These were not acts of generosity. They were acts of preservation. Leaders understood that endless debt would fracture society. Centuries later, medieval England operated on an entirely different model. The crown issued tally sticks, wooden rods, split in half, notched 2 record amounts owed. One half remained with the treasury, the other circulated among citizens as payment. These tally sticks functioned as money for over 500 years. They did not carry compounding interest, nor were they dependent on private lending. They were simple records of exchange backed by royal authority. For half a millennium, a kingdom ran on carved wood. Even in modern history, alternatives emerged. During the American Civil War, the United States government issued greenbacks, paper currency created directly by the Treasury to fund the war effort. Unlike today's system, these notes were not born from bank loans. They were introduced as money itself, legal tender for debts and taxes. For a time, the economy functioned on debt-free currency. None of these systems were perfect. Some collapsed, others were replaced. But they prove a critical point. Money has taken many forms. Debt-based issuance is only one chapter in a much longer story. History shows us that money can be designed differently. The present confirms that experimentation never stopped. In 1934, during the depths of the Great Depression, Swiss businesses faced a severe problem. Banks were restricting credit and liquidity had evaporated. Companies had goods to sell and services to offer, but they lacked francs to transact. In response, a group of entrepreneurs created the Weerbank, a mutual credit system that allowed businesses to trade using an internal currency. Instead of borrowing money at interest, members extended credit to one another within a closed network. Transactions were recorded in a shared ledger. The system did not eliminate obligations entirely, but it reduced dependence on conventional bank loans. Nearly a century later, WER still operates stabilizing trade during downturns. Communities elsewhere have tried similar ideas. Local currencies such as the Bristol pound in the United Kingdom or Berkshires in the United States were designed to circulate within defined regions. Their purpose was not to overthrow national money, but to strengthen local economies by keeping value from leaking outward into global financial systems. These currencies operate on trust and participation rather than compounding debt. Then there is cryptocurrency. Bitcoin, introduced in 2009, proposed a radically different architecture. Its supply is capped, and new units are created through algorithmic mining rather than bank lending. It does not rely on government bonds or private credit expansion. Supporters argue that this limits inflation and removes central control. Critics point to volatility and speculative excess. Regardless of perspective, its existence proves something essential. Money can be built through code and consensus, not only through debt. These experiments differ in scale and success, but they share a common message. Alternatives are not theoretical. They are real, operating quietly alongside the dominant system. If alternatives exist, why does the debt-based system remain dominant? The answer lies less in ideology and more in inertia and incentives. Modern financial architecture is deeply embedded in global institutions. Commercial banks rely on lending for profit. Governments rely on bond markets to finance deficits without immediate taxation. Pension funds, insurance companies, and investment firms depend on predictable interest-bearing assets to meet their obligations. Entire layers of the global economy are structured around the assumption that debt will continue to expand. Changing the monetary foundation would disrupt this network. A system where money is issued without debt would reduce the role of private banks in money creation. It could limit the profitability of lending institutions and alter the balance of financial power. Even modest reforms provoke resistance because they threaten established revenue streams. There is also the issue of trust. The current model, for all its flaws, is familiar. Markets understand it. Legal systems are built around it. Contracts, derivatives, sovereign bonds, and global trade agreements all assume its permanence. Replacing or restructuring it would require coordination at a scale rarely achieved in international politics. Finally, there is psychological comfort. Debt-based growth creates the appearance of progress. Expanding credit fuels consumption, asset appreciation, and rising GDP. Political leaders can point to growth metrics as evidence of success. Alternatives, particularly those that impose stricter limits on expansion, may appear restrictive or uncertain. Resistance, therefore, does not require villains. It emerges naturally from systems that reward continuity. When money is intertwined with debt, power, and profit, preserving the status quo becomes the safest path for those who benefit from it. This conversation is not abstract theory. It is unfolding in real time. Global debt has reached historic levels. Governments carry obligations measured in the tens of trillions. Households manage mortgages, student loans, and credit balances that stretch decades into the future. Corporations rely on cheap borrowing to finance expansion and stock buybacks. The scale is unprecedented, and the system depends on it continuing to grow. When growth slows, strain appears immediately. Central banks respond by lowering interest rates or injecting liquidity into markets. Governments increase spending financed through additional borrowing. Each crisis is met with the same prescription: more debt to stabilize existing debt. The cycle becomes self-reinforcing. For individuals, the effects are tangible. Inflation reduces purchasing power, particularly when wages fail to keep pace. Housing becomes more expensive as credit expands. Asset prices rise beyond the reach of younger generations. Savings held in cash gradually lose value. Even those who avoid personal borrowing remain exposed through taxation and economic volatility. The fragility lies not only in the numbers, but in confidence. Debt-based money functions because participants believe obligations will be honored. If trust weakens, whether through inflation, default, or political instability, the system reacts sharply. Markets reprice risk. Credit tightens growth contracts. Understanding this structure is not about predicting collapse. It is about recognizing vulnerability. A monetary system built on expanding obligation requires constant balance. When that balance falters, the consequences move quickly from financial markets into everyday life. The question, therefore, is not whether debt-based money works. It clearly does, until it does not. The deeper question is whether reliance on perpetual expansion is sustainable in a world facing demographic shifts, environmental constraints, and rising geopolitical tension. Money feels permanent. It feels as though it has always existed in its present form, as though bank accounts, interest rates, and government bonds are natural features of civilization. But history tells a quieter, more revealing story. Money is not a law of physics. It is not gravity. It is not fixed. It is a design. At different moments in time, societies have tied money to grain, to precious metals, to wooden tally sticks, to government notes, to mutual credit ledgers, and now to digital code. Some systems endured for centuries. Others collapsed within years. Each reflected the priorities and power structures of its era. Our current model, where most money enters circulation as debt, is not inevitable. It persists because it aligns with powerful incentives and because it is deeply woven into global institutions. But that does not make it permanent. Designs can be modified. Structures can evolve. The purpose of understanding this is not to romanticize the past or to assume that any alternative would be flawless. Every monetary system carries trade-offs. The point is awareness. When we recognize that money is constructed, we gain the ability to question it. If debt is embedded in the foundation, we should ask how much expansion is sustainable. If growth depends on obligation, we should consider who bears the cost. And if trust is the true backbone of money, we should protect it carefully. Civilizations have risen and fallen around the management of money. Those that endured were not necessarily the wealthiest, but the most adaptable. They understood that economic systems are tools, not destiny. Money does not have to mean debt. It means what societies choose to design it to mean. And that choice, ultimately, is never permanent.